three things that I want to focus on today's update. These are actually a lot of people concerned right now. Okay, the first concern is U.S. recession. Whether U.S. will dip into recession. Okay, this is a lot of people concerned. Earlier of the year, we don't see any concern on recession. Okay, but if you notice that what happened towards second half of the year, when we see the economic data, a lot of people started to concern about a possibility of recession. Now, currently, the market is expecting maybe 30 to 40% chance of a recession in US. It is quite difficult for US to actually dip into a recession unless they really have a big negative shock. And history tells us that only when they have a very big negative shock that they will go into a recession. And in fact, later I will explain you some slides. They are going for a slowdown, but it may not be a recession. The second things that we are going to talk about is Europe. Okay, Europe is currently the central of a lot of people concerned. Okay, more so than US. And lastly, I want to bring you to some opportunity that we see in Asia. Okay, let's do a bit of recall on what is quite fresh in our mind about history. Now, every time I see, because I myself in this career is about 17 years in the investment industry, I have gone through many crises. Okay, some of you in 1993, you know we have a super bull market in 1993. Then it collapsed in 94. Then you also see that there's a second bull run in 95, 96. Then you have a crisis. And then 97, 98, we have a Asia financial crisis. And then in 2000, closer to 2001, we have a tech crisis. And then SARS crisis. And then in 2008, we have a global financial crisis where they have a housing bubble burst in US. And now, it looks like we are facing another crisis. So we have gone through many crises. But that's why I want to show you that history repeated itself. And every time the crisis, events are different. But the pattern and the rebound seems to be quite similar. Quite similar. So everything that goes into a negative territory and becomes so cheap, to the extent it's too cheap to be ignored, people tend to want to find a reason to buy into the market. Now, I just brief a bit for you who are at the back, maybe a bit difficult to see. In 2008, we have red flags everywhere. We have China market dropped by 51%, India market dropped by 65%, Malaysia close to 40% correction, Indonesia close to 51% correction. The correction was so sharp that people thought there's no hope. That's when a lot of investors pull out and they left the market. They left the market. So unfortunately, a lot of people did not participate in the 2009 rebound. And the rebound was very sharp. Whatever that dropped a lot tends to rebound back quite sharply. China up by 63% in 2009. India more than double in 2009. Malaysia up by 45%. Indonesia up by 87%. And we have another year or strong year in 2010. And when I look back at history, history also tells us one thing. Normally, the bear market are pretty short. And it hardly go beyond a year. Hardly. It doesn't mean that it will not go beyond a year. Okay? If it's like 1929, we have a Great Depression and all that, it does go beyond a year. But then, most of the bear market are pretty short compared to a bull market. Bull market tends to be longer. And this time round, when we're talking about global financial crisis, it's just a 1 year bear market and then it rebounded very strongly. And the bull take charge for another year. So you have another strong market in Malaysia up by 38%. In Indonesia up by 57%. Okay? Indonesia has a very strong structural story. And therefore, when the market rebound, Indonesia will be a very good market to invest. And of course, this year no good. This year turns red everywhere. Okay? You don't feel it. Most of you may not feel the sharp correction. But in most part of Asia, most of the market started correction in beginning of the year. Okay? Malaysia, Indonesia are quite late. In the sense that Malaysia only started real correction. We really feel it in the month of August. And in Indonesia, you only feel it very recently that they started to have some correction. Okay? But nevertheless, if you look at overall, the developed market as a whole, Asia was also not spared. Especially China. China was one of the worst performing market in 2010, and 2011 continued to bleed. Okay? Did very poorly because of inflation scare. India did very badly, down by almost 30% because of inflation scare. So this is the scenario that we are looking at this year. Okay? Whenever the correction was very sharp, the correction period tends to be shorter. The sharper the drop, the correction period will be shorter. Okay? This is what we are facing now. Now we are in the midst of a panic to capitulation. Okay? Capitulation is a term that normally if you look at the newspaper, it shows you the word capitulation. It means that people are really panic selling. They just sell and the selling momentum is sharp. They're just being sold down badly. Okay? You see 3%, 5% a day kind of correction. That is capitulation. But as I said just now, I repeat it again and again, when you have a very sharp drop, it's shorter your correction period. Okay? Like for example, what happened in Japan? Japan, 2 decades away, 20 years ago, when Japan has a problem, we know now when we look back at Japan, Japan has deflation for a very long period and recovery very, very slow. 20 years ago, their price to earnings ratio of Japan is 60 times. Now because they take things very slowly, so it took them 20 years to correct to this current level. Okay? But currently, if you look at most of the market are trading at price to earnings ratio of 10 times or below. So it's very cheap. So this is the 3 topics I'm going to talk. This is additional that the other session wouldn't see. I just read a magazine called The Economist. I found this cartoon, very nice cartoon. Look at it. The whole group of American and Eurozone economy, they are all in this problematic bus. Okay? This could be a slow recovery. I mean, from the cartoon itself, look very, very horrible because this truck don't even have tire. I just find it's interesting, you know. How are they going to pull out from the whole situation led by bank with this kind of situation? Tire puncture here, no tire here. You know? And they are expecting a slow recovery. Okay? I hope this won't scare you off. Every time when we have a crisis, it comes to a point when people panic and look at some of these things. They can't find a way out. But every time, if you look back at history, every time we have a crisis, to the extent that people can't find any way out, and when there's small improvement, just a small improvement, okay, things will rebound. And hopefully you remember the chart that I showed you. After a red flag everywhere, it followed by a green flag. So I hope that you will see opportunity. You try to position yourself to make sure that you are there when the market rebound. Okay, because things are cheap. Okay, now I want to really show you something that is not very encouraging. I'm going to show you the reality of the economy today. You look at some of the leading indicator. For economists, we normally look at and economists and fund managers, we look at leading indicators. The one that will show us how the economy is going to perform over the next few months. Some of the leading indicators that we use, like for example, US ISM index. The trend is quite obvious, is coming off. Can you see the trend? It's off, slowing down. It shows that US is going to have a more difficult period. The activity is going to slow down in the coming months. And likewise, you have OECD leading indicator is also showing that for the world, economy is slowing down. This is another leading indicator that we use, Purchasing Manager Index. Now, how do we read this number? Even though you don't know anything about economics, just remember this. We use a leading indicator in this way. Anything that is above 50, it shows that economy is expanding. Anything that is below 50, it shows that the economy is contracting or slowing down. Okay? First thing we read is the number itself. Second thing that we read is the trend. Whether the number continue to drop. If it continue to drop, it means that the economy is slowing down. If the number continue to go up, it means that the economy is improving. Okay? So this is how we read the leading indicator. And you look at the number. Yes, for US, the number is slowing down. Can you see the trend? Even though the trend is slowing down means the economy is slowing down. However, if you look at the point here, as of August, PMI figure shows 50.6. It is above the threshold 50. So it means that the economy is still expanding. In other words, the economy is slowing down, but the economy is still positive growth. It's not a contracting. You also see the same thing here. In here, we are still okay. In China, it's still okay. In Japan, it's still okay. But Eurozone is an issue. If you look at Eurozone, PMI has actually dropped from 59 in February all the way to below 50. And currently, it's already below 50, which means that there is a risk that Eurozone may enter into recession. And you look at two big economies in Eurozone, which is Germany and France. They are growing very well, and beginning of the year, nobody actually have any concern on the growth, recovering very well. But if you look at the PMI figure, they have actually dropped quite badly, especially for Germany. It's already below 50. France already below 50. Okay? So these are our concerns that Eurozone economy is slowing down much, much sharper than US. Another thing that we look at is actually unemployment in US. This is very important. This is not a leading indicator. But unemployment is very important in US because 70% of US GDP or 70% of US economies actually come from consumption, which means consumer have to spend. If consumer continue to spend, then the economy is doing well. But if consumer deleverage, stop spending, then it's no good for the economy. Look at what happened in the unemployment. Normally, in the normal months, the net job creation is about 100 to 150,000 per month. That is healthy level. 150,000 per month is okay. For the first few months of the year, you notice that the public sector, the government side, cutting jobs. But the private sectors are recruiting. So net is still positive. So it's a healthy number. Unfortunately, the net jobs creation has come off quite sharply. Okay? In fact, you see here, June, July is very low. And in August, the announcement actually panicked a lot of people. And investors reacted very negatively on the job number because in August, there is zero job creation. No job creation in the month of August. So it shows that whatever that the government did previously does not really help. So because of that, so therefore, you see the president have to come up with the Job Acts, okay, to help. This Job Act turns to be about 400 over billion US dollar to help to create jobs. We believe that the US government are very proactive. Okay? And this time round, I also personally believe that Congress will not put too much resistance to the announcement of the Job Acts, the proposal of Job Acts. Because if Republicans are against the whole idea, then if unemployment figure turns worse, then a lot of the US citizens will point a finger to Republicans because you're not helping the economy at all. Just because of your political agenda, you're not helping the president. So the president has actually done something great by proposing these Job Acts, and I think that Congress will overall broadly may approve these Job Acts. So we hope to see some improvement in the job numbers in the coming months. And at the same time, you see the unemployment. Non-farm unemployment is the figure that we normally monitor. Currently, the unemployment rate is still 9.1%. Okay? It is not a healthy number because this unemployment number only count those people that actively look for a job. If those people that look for a job and then after some time cannot find a job, they are very discouraged, they give up. These are not counted. Okay? So it's quite bad. Okay? Of course, this number, if 9.1% continue, it is not good for the US economy. And we expect that the US may take a couple of years to solve this unemployment problem. It is not a near-term thing. It may take about 3 to 5 years. The way we look at it, to have a meaningful, more recovery in the consumption. Housing market, the number that doesn't show any improvement yet. Yes, it has bottomed. The housing starts and building permits as well as new existing home sales has bottomed, but it remains sluggish. We haven't really seen any improvement or a meaningful rebound yet on that front.